Hello friends, welcome back to our channel. This is the continuation lecture of the series of Managerial Economics, in which I am discussing about the analysis of market demand. Today I will discuss the topic of law of demand. What is law of demand? Basically, law of demand simply states a relationship between the price of a commodity and the quantity demanded. What kind of relationship is there? It says the commodity demanded are inversely related with the prices. So, the law says that if the price of the commodity increases, the quantity demanded for that particular commodity will decrease and vice versa, given the other things remain constant. Now, what are these other things? These other things are nothing but the determinants of the demand. Determinants of demand that we have already discussed in market demand function. What are the determinants? Once again, let me quickly go through it. First is the income of the consumer. Second is the price of the related goods. Then the consumer taste and preferences. Then also the demand. The other thing which is very important in this is the assumption of the demand for the commodity should be continuous. I'll discuss it again. And that the consumers do not expect any change in the price of the particular commodity in the near future. So, if these things remain constant, then it means if the other determinants has no effect in case of law of demand on the particular commodity. The effect on the quantity demanded for a commodity is coming only from the price of that particular commodity. Okay, so this is what the law of demand states, and these other things that remains constant are also called the assumptions of the law of demand. So this law holds true only under these assumptions. What are these assumptions? Once again, I'll repeat that all the other determinants are remain constant, only then the law of demand holds true, that the prices and the quantity of a commodity are inversely related, and it can be proven again and again empirically. Now, moving on to the next slide, that is demand schedule and demand curve. These are two another topics. Demand schedule is nothing but a table or a schedule that depicts the relationship in quantity terms. Like you can see on the screen that quantity demanded is ascending, and and the price of the commodity is going in the reverse direction or descending. When we depict the demand schedule on a graph, that is called the demand curve. Now, there are certain exceptions to the law of demand. What are these exceptions? Means when this law of demand will not hold true in case of certain commodities. Because of the nature of these commodities, it happens that the law of demand does not hold true. What are these commodities? There are two kinds of basically commodities in whose case the law of demand does not hold true. One is Giffen or inferior goods, other is prestige goods. What happens in case of inferior goods? They are called inferior. It is a subjective matter. However, we all know that we can take very basic example of millet, and this is a coarse kind of food grain. It is considered inferior to wheat. Okay, so what happens when in case of inferior goods, even if the price is, sometimes what happens when the price of such product goes down or decreases, their demand does not increase. Okay, so in this case it does not hold true, and they are also called inferior goods. Why? Because you can say when the demand, when the price is decreasing, it affects in the real income in the hand of the consumer becomes more, means their purchasing power, whatever income they have, their purchasing power increases in relation with this particular product. So what happens? They think of switching to the superior quality product instead of consuming the same kind of product. Now, The extreme opposite is prestige or status goods. What happened in this case? There are certain goods which people buy to show off their status, and these products are become status symbols, such as gems studded jewelry, very high end luxury car, and products like that. So the higher the prices, it does not affect the demand for these commodities. Those who can afford, they go for these products even if they are higher. Sometimes they buy more of it because it is actually the satisfaction they are deriving out of this product is because of their high prices, and that is why it is called prestige goods. The third exception could be what happens when sometimes even if the prices are increasing in case of normal goods only, but consumer thinks that the price of this product will be even higher in the future. It could be because of anything, because of certain situation of shortage, or because of certain other socio-political environment, that consumers are expecting that the prices of these goods are going to go even higher in the future, so they will not decrease the quantity demanded for these kind of product, normal product, because it is essential and they know that the prices will be even more higher, so better to purchase at given higher prices. So these are the exceptions of the law of demand, where it does not hold true, where we cannot find the inverse relationship as the law of demand states between the price of commodity and the quantity demanded. And in today's lecture, the last topic is regarding the shifts in the demand curve versus movement along the demand curve. Now, what does it mean? We can find sometimes demand curve is changing its place or shifting its position. So actually there are two cases when the demand curve will shift or move. First case here, it's called the shift in the demand curve. As you can see in the first panel where I have written increase or decrease in the demand curve, we can see that the original demand curve, which is the line in between represented by capital D, it is moving forward to D1 or moving backward to D2, and this demand curve is shifting. It is called shift. It can be increase or decrease. Why it is shifting? Because you can see the prices are not changing in this case. In the panel, on x-axis there is quantity, on y-axis there are price, but there is no movement in the price. There is no change in the price, only the quantity demanded is changing, and that is why the demand curve has shifted. There is an increase when it is moving forward, and there is a decrease when it is moving backward. But and that is bringing the change in the price, but price is not actually changing. So why this change is happening? It shows that the change in this demand curve is happening because of other factors, other determinants of the demand function than the price. Okay, now the second panel shows a different kind of change in the demand curve. There is also a change in the demand quantity demanded, but the change is happening along the same demand curve. There is no new demand curve. The same demand curve, we can see that on the same demand curve there is a movement from point A to point B and point A to point C. It is moving upward and downward. So what is happening in this panel? We can see that there is a change in the quantity demanded because of the changes in the prices of the commodity. From original point price P and original quantity Q, at that time we have a point A on the demand curve. So that is the quantity demanded at price P, and that gives us a point on demand curve A. That is point A gives us the combination price quantity combination of P and Q. But when there is decrease in the price from P to P1, we can see that there is increase in the quantity from Q to Q1. Okay, and we get a new point on demand curve which is B, which is slightly lower than A. So what is happening? It is giving a new combination of price and quantity, where the quantity has increased and price has decreased, and it is a new combination, and we can see there is a movement along the demand curve, and it is the point on demand curve A has moved to B, which is lower than the previous point. Okay, so of course there is a new shift on the demand curve, there is a shift on the demand curve, and a new quantity price combination is there, and this change on the in the demand is happening because of the change in the price. Now, why this concept is important in managerial economics? It is important from the perspective of the business decision, from the perspective of manager, if he wishes to take a decision regarding how to maximize his sales revenue and all. So he will see in case of this panel A, increase and decrease, there the demand is shifting not because of the changes in the price, it is happening because of the changes in other things. Now, other determinant could be the increase in the demand is happening maybe because of the increase in the consumer's income. So this is what a manager must know. If he knows why it is happening, then he may utilize this as an opportunity. Okay, and it is generally this first scenario which the managers look for, because in the second scenario, the change in the demand is happening only because of the changes in the price. So somewhere you have to compromise. If you increase the price, you generally lose some quantity demanded for individual firm and the overall market. So you don't want that. You want this first situation. So this concept helps the manager in making a decision. Like all the other concepts of demand helps a manager in taking their decision. So with this, today's lecture is over. Thank you.